Yes. So first, we're going to define what is accounting. So accounting, in simple words, okay, it's the language of a business. Although you won't have to put that answer in your exam, okay. But just think of it this as the language of business. But accounting basically is involves recording, summarizing, analyzing, collecting, and preparing financial information for its intended users. Okay. It's all about financial transactions being recorded, analyzed, right, presented to people who need those financial statements. For example, the banks, the board of directors, shareholders, investors. Okay. Yes. So the first thing we're going to look at is the main accounts you'll be dealing with in this course. All right. Yes. So the first account you need to first type is what we call assets. Okay. Assets basically these are things that we own. Okay. Things we own. Okay. That can bring us money. Okay. Or of economic value. Okay. Yes. So assets are broken down into two types. You've got current assets and non-current assets. What separates them or what differentiates them is the time period they can be owned for. Okay, current assets have to be owned, can be owned and used up within a year. Okay, current assets. Okay, can only own them and they can only be used up within a year. The non-current assets, you can own them for more than a year. Okay, so we need to look at the type of current assets. Right. Yes. So the first current asset that we're going to look at is inventory or stock. Okay. And this is goods that are held for resale to customers. Okay. This is the first current asset. Inventory or stock. The goods, basically the goods in the shop. Okay. Then we have trade receivables. These are people who owe us money. Okay, colleagues. Trade receivables, people who owe us money. Okay, they are an asset. Okay, then you've got cash at hand or cash in the bank. Okay, cash is also a current asset. Okay, apart from that, apart from, these trade receivables also are called debtors. Okay, yes. Then you've got prepayments. These are expenses that you have paid for in advance. All right. For example, okay, if you pay your school your tuition fees 3 years in advance, all right, that money technically is still yours until those 3 years pass. Then the school would have earned that money. So should something happen uh, during that period, something should happen. Maybe you can't continue at the school, or something just drastic happens. You can ask for your money back. Okay. That's why we're saying prepaid expenses are like assets. Because yes, you've paid for an expense in advance, but there's a possibility you can get your money back if you need it. Although here in Zambia, you would be lucky to even get your money back because it will be gone. One moment you pay for it in advance, I don't think the person will want to give you their money back. Colleagues, would you want to give someone the money back if they've paid you in advance, Madam Lena? Someone has paid you for a service for 3 years in advance. Then in year two, they're saying, okay, can I just have my money back for the year in advance I paid for? Yes, it's better when there's an agreement where you can actually ask for it back. Okay. So yes, prepaid expenses. Okay, prepaid expenses are an asset. Okay, colleagues, you have to put prepaid expenses. Okay, then you've got accrued income or income receivable. This is where you now have been paid in advance by somebody. Oh, no, no, wait, 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 no. That's prepaid income. Accrued income. This is where you have done a service for somebody. They haven't yet paid you and they're owing you money. Okay. Let's say you enter into a contract with somebody and you say, okay, it may be a 5 month contract. And you say, okay, you'll be paying me 1,000 every month. So month one comes, the person hasn't paid you. So it means they're owing you 1,000. Month two passes, the person hasn't paid you. Now means they're owing you 2,000. Have you seen? The accrued income is building. Okay. It's money that's being owed to you for a service that you've provided. Okay. Yes, that is accrued income. Okay, it's also a current asset. Yes. Then you've got cash and cash equivalents. Oh, I already spoke about cash. Cash equivalents, these are short term investments that you can sell for money, like treasury bills. Okay. If the company needs money, it can sell its treasury bills and get the money. Okay. Treasury bills are just a government instrument. When government wants to borrow money in the short term, they issue out treasury bills. Okay. So the company can hold on to those treasury bills. And when the company needs money, it can resell those treasury bills to get their money. Yes, colleagues, are we okay with the current assets? These are the main current assets you'll be seeing in this course. Are there any questions? Hmm. No, bonds are long term. Yes, but first I'll check further. Maybe it can be included. I need to investigate further because I think a bond also you can resell it at any time, right? Okay, then I think it will fall through also because it's just something you can easily sell fast, and get money. So I would say, okay, yeah, I think a bond will be put in there. Okay, you've got non-current assets. These are now what you can own for more than a year. Okay, they're broken down into tangible and intangible non-current assets. Okay, yes. So let's look at the tangible non-current assets, which are these are the physical non-current assets: land, buildings, machinery, equipment, motor vehicles, okay, fixtures and fittings. Okay, these are things you can own for more than a year. Okay, yes. Any questions? Okay, now there are the intangible non-current assets. Okay, these are not physical. Okay, yes. So the first one is goodwill. Okay, in simple words, goodwill is the value of all the things that make a business run successful. Okay, the value of all things that makes a business run successful. Okay. Or another way I can think of it, the value of a business is reputation, brand strength, customer loyalty, okay, supplier relations. So basically, this is what it's all about. For example, if you have built a business, okay, you've worked hard for your business. Now, when you want to sell that business, okay, obviously, the person who is going to buy the business from you is going to benefit from all the hard work you have done. Okay, because probably with your business, you built a customer base. So the person who's buying your business is inheriting that customer base. Okay, the brand loyalty for your business, that person is inheriting that. The strategic location of your business, if your business is located near suppliers and everything, that person is inheriting that. So those factors, okay, brand loyalty, strategic relationships, customer base, you want to put a value to that, okay, because someone's going to benefit off your hard work. So you want to put a value to that. Okay. So when you're determining this, how much you want to sell your business for, you determine a price, then you put goodwill on top of that price. Okay. That goodwill will represent, excuse me, the hard work you put in for that business to make it run successful. Okay. So goodwill is a intangible non-current asset. Yeah. Any questions? Okay. Then you've got patents. Okay. Exclusive rights granted by the government to make, use, and sell an invention for a set period. Okay. So when you invent something, you can get a patent for it, so that you can control the use of this invention and you're able to sell it. No one can come and take your invention from you. They'll be sued. Okay. Like that woman who patented the Coppola Queen title. Okay. Meaning anyone who tries to use that title will be sued because it's her. It's her patent. Okay. Copyrights, exclusive rights to reproduce, publish, and sell literary, music, or artistic work. Okay, yeah, this is mostly for like in the music industry, movie industry. Okay, where no one can reproduce your work and claim it as yours. Okay, there you are in control of the work that you produce and how it is used. Okay, then also trademarks, a symbol, word, or phrase legally registered to represent a company. All right, yes. And also certain licenses, legal permits granted by an authority to operate a business or use certain technology. These are the intangible, non current assets. Okay, yes. So that's the first type of account, assets. Assets are broken down into current assets and non current assets. Okay, number two, okay, we'll go to before because drawings and capital go hand in hand. So we'll go to liabilities. Colleagues, liabilities, this is what we owe, okay, what the business owes, okay. Mm, and also them, they are broken down into two segments, current liabilities and non-current liabilities. Okay. Current liabilities, this is what you owe and has to be paid within a year. Okay, debt and obligations that need to be settled within a year. Okay, examples: overdrafts, trade payables, people who you owe money. Okay, also called other words you might hear is here creditors. Okay, prepaid income. Okay, prepaid income. This is the one where someone pays you in advance. Okay, so let's say you are doing a service for somebody, a 6 month service for this person. You have agreed on an amount that needs to be charged per month. Then the person pays you the whole amount. That's prepaid income. So it's a liability because should you fail to deliver, you need to pay that money back because you haven't earned all of it. Okay, you haven't earned all of it. Okay, that's why prepaid income is a liability. Okay, another current liability is accrued expenses. Accrued expenses, basically, these are expenses which you need to pay for, but you haven't paid for them. So they just keep on building up. Let's say your electricity bill is due this month, you don't pay it, you're owing the electricity company. The second month comes, the electricity bill falls due, you don't pay it, you're owing the electricity company. It just keeps on building. Okay. So accrued expenses, okay, prepaid income or deferred revenue. These are current liabilities. Okay. Yes. Then you have non-current liabilities. Okay. This is what you owe that can be paid after a year. Okay. Yes. Just any long-term bonds, long-term debt. I mean, any long-term debt that the company engages in is a non-current liability. If the company gets a 5 year loan, a 4 year loan, a 3 year loan, okay, that's a non-current liability. Okay, long-term loans, mortgages, loan for a house, basically, loan used to purchase property, bonds payable. Okay, so if let's say if the company sells corporate bonds, okay, then it has to it's going to be owing its the people who purchase those bonds from it because to be paying interest payments, and at the end of the year, when the bonds mature, it has to pay back the par value of the bond. And so any long-term loan falls under non-current liabilities. Okay, the third account, capital. Okay, capital for sole traders and partnerships. For businesses, it's equity. Okay, for companies, it's equity. For sole traders, it's capital. So this capital is the resources, money, and or I'll just say resources put into the business by the owner. And these resources can be money, assets, okay, mm, equipment. Okay. Yes, that's what capital is. Another way to look at capital is what the business owes the owner. Okay, if the company should close, okay, whatever capital you have in there is owed back to you by the business. So, before we go to the fourth account, you need to remember the accounting equation. Assets equals liabilities plus capital. Okay, and this is the accounting equation. All right. Yes. And yes, capital, it increases with owner's investment. If you're investing in more, if you make profit, your capital also increases. Okay. But capital decreases with drawings. Drawings, this is when or the owner of a business removes money or resources for personal use. Okay. Drawings and losses reduce capital. Okay. Then investing new things or putting new resources into the business and profit increase capital. Okay. So we come now to drawings. Drawings, as I said, where the owner of the business removes money or resources for personal use. So drawings is a contra capital account, meaning it reduces the value of our capital. In accounts, whenever you hear this word contra, just know it reduces something. So drawings reduces capital. Okay. Yes. So that's the fourth account, drawings. Number five, income and revenue. Okay. Money in from the operations of a business. Okay. Yes. This one is self-explanatory. Okay. Yes. So usually, especially when you hear this word received in accounts, like if you hear interest received, commission received, rent received, that's a form of income. Okay. Maybe that income is from an side business the business does. Okay. Sales revenue is the main income, but then there can be other if the business rents out buildings or did a service for another company where it's odd commission. You hear these things: interest received, rent received, commission received, or if it even has the word receivable, just know it's a form of income. Okay. But when it has the title attached, when you see, like for example, let me just illustrate what I mean. When you say interest received, income received, or yeah, income or the interest received by the company. Okay, they've been paid. Now, if you hear interest receivable, this is accrued income. Okay, accrued income. The company is owed that money, but it hasn't been paid. Okay, interest being owed to the company, accrued income. Okay, yes, but both of them are treated the same in the financial statements. Okay, as you're going once you're going to see when we talk about the accounting concepts, the accruals concept. Okay, which says even record income or expenses even though no money has been received or paid out. But yes, that's how I need you to interpret these things. If you see the word received or receivable, just know this is income to the company. And sales revenue or service revenue, that is the main revenue, main income to the company. That's number five. Then number six is expenses. Again, expenses are self-explanatory. Okay. We all we all incur these every day. Okay. Now, The contra accounts, which you need to be aware of. Okay, you've got contra expense accounts. Okay, contra exp. These are accounts that reduce the expense. Okay, so when you hear this word purchase returns or return outwards, when you as a business return goods back to your supply, so when you return goods back to your supplier, that purchasing expense you paid has to drop because you've returned some goods. Okay, so what you paid for those goods has to drop. Okay, that is return outwards or purchases returns. Okay. Then discount received. Okay, purchase discounts. When you hear the word discount received, this you can treat it as a contra expense because remember discounts reduce the purchases expense. But you can also take it as income because that discount that you've got you have saved some money. So that saved money is treated also as income. So you will see what I mean once we reach financial statements on this discount received. It can be looked at in two ways. So here how we're looking at it is it reduces the purchases expense. So it can also fit under contra expense. Okay. Yes, even refunds or rebates received, amounts returned by suppliers after payment, which reduces expenses. Contra assets, these drop the value of assets. Accumulated depreciation. Okay. Depreciation is the loss in the value of an asset due to wear and tear. As you use an asset, its value goes down. So with accounts, every year you'll be charging a depreciation expense to the asset. Now, as you're charging the depreciation expense to the asset, this accumulated depreciation will be building up. As it builds up, it lowers the value of the asset. Um, Allowance for irrecoverable debts or provision for doubtful debts. Okay, this is an estimate of the money that you might not receive from the people who owe you money. Okay, if you conduct credit sales, it doesn't mean all your customers will pay you. Some might run away. So, according to the prudence concept in accounts, okay, where if you can see the company will make losses, record them. Okay, yes. So, as a business, you have to make an estimate to say this is the amount I might not get back from the people who owe me. Okay? So this reduces the asset, it reduces the trade receivables. Okay. Accumulated depreciation, the asset it reduces the current assets. Okay. Accumulated amortization. This is so amortization is the same as depreciation. It's just that depreciation is for tangible as and non-current assets. Amortization is for intangible non-current assets. Okay. Amortization is also the loss in the value of an intangible non-current asset. Okay. So as the years pass, the value of that asset drops. Okay. So just remember depreciation is for the physical non-current assets. Amortization is for the intangible non-current assets. Both are reducing the value of the assets. Okay, and then there's also accumulated depletion. Okay, reduces the value of natural resources such as mines or oil fields. Okay, yes. excuse me. Then we have contra revenue accounts. These reduce the revenue of the business. Okay. Sales returns. Okay. This thing, when your customers bring back goods to you, you've sold goods to your customer, you've made your money. Now they come back and say some goods are bad, so we need a refund. So it means that revenue you earned has to drop because some goods have been brought back. Okay. Sales discounts, like discount allowed, also this it reduces the revenue that you'll be getting. If you're offering your customers discounts, okay, it reduces the revenue that you'll be getting, your sales revenue. Okay, even sales allowances, price reductions given to customers for damaged or defective goods without returning the goods. Okay, so if someone buys a defective good from you and they find there's a fault in it, you can say, okay, yeah, we can reduce the price you've paid, but you can keep the good. Okay, so long as the defect is not that important, where you can still use the good. Okay, yes. Then drawings was contra capital. Okay, when you do company accounts, you are going to hear about treasury shares. Okay, this is when a company buys back its shares, and this reduces the shareholders' equity. Okay, this is for company accounts. But yes, basically, colleagues, those are the accounts